Good afternoon, everyone, and happy Good Friday. We're going to give it just a minute here or two to let people kind of come on and before we get started. So appreciate you guys taking the time to join us today. So we'll get started here in a minute. All right, we'll get going here. Again, good afternoon, everyone. Appreciate you guys joining us on this Good Friday. We just realized today that it was somewhat of a holiday, so I appreciate you guys joining us when we're doing our educational series on 1031, Beyond the 1031, talking about the 1031 platform, the opportunities out there in the marketplace, talk about the DSTs, and talk about 721s as well. My name is Kerry Peoples. I'm the head of capital markets here at Bonaventure. I'm joined by our head of tax equities strategist, Mike Auerbach. And we will talk about, we'll introduce Bonaventure to the audience out here. This is strictly an educational series. We're not here to sell product. We're here to introduce Bonaventure to you guys, kind of who we are, what we do, and also educate the marketplace out there on 1031 exchanges and the marketplace for DSTs and 721. So we'll get going. All right. Bonaventure, who we are. We are a multifamily sponsor, developer, strategist. Basically, the family was founded in Virginia, started in multifamily in the 60s. The Dutton family was a large landowner and still is in around the Virginia area and sorry, the state of Virginia. They had a tax problem in the 60s and they partnered up with a developer to help mitigate their tax problem. And they actually developed a 283 unit multifamily apartment complex on their property, and which did them very well for many, many years. And in 1999, at the young age of 25, our founder and CEO, Dwight Dunn, went to his father and said we should buy their partners out, which is a major developer. And he agreed. And Bonaventure was born in the year 2000, or sorry, 1999. So we're celebrating our 26th year being in business. And it started as a multifamily development company in the state of Virginia. Today we've grown to about a $3 billion balance sheet. We have one of our biggest and reputable stats that we like to highlight is we have 590 million of our own capital invested alongside our partners in all of our programs. This slide is a little outdated. We have 9,200 units today. We've had 36 full cycle events since 1999, with an average IRR of 24%. Now that number is tremendous, and the only way to get to a high number like that is through development deals. And so like I said, a lot of our pre early days were a lot of development deals that we've seasoned our assets and turned around and sold in the marketplace for some nice multiples. Okay. Um, this is with our track record. Sorry, it's a lot going on here, but we had to show the slide for compliance reasons to state our track record. Um, and so let me tell you about who Bonaventure, who we are, where we are, what sector we invest in, which is multifamily and developing as well. Kind of our strategy, where we've come from and where we're at today and where we're going, and kind of our structures. So our structures, we have a perpetual REIT in the marketplace with 1.3 billion of assets. We seeded it with 135 million of equity of our own capital back in September of 2021. We have two share classes in that REIT. We have a common and a preferred share class. And we do talk about this REIT because our DST programs will eventually 721 up in the REIT. Again, this is for educational purposes, just trying to give you guys a picture of who we are. And then our 721 and DST platform, in which we'll talk about a little bit more down the road with Mike here further along in our presentation. And also we do some co-direct investments for some kind of a bespoke custom solutions for anything that anyone has a situation of $10 million and up of a tax equity solution that we could kind of help partner with them and help solve some of their issues on tax basis. We started as a multifamily development. We have our own, we're vertically integrated real estate operator. We have all of our different pillars across our development side, our property management side, which is Vest Residential, and back in during the COVID days to help generate more NOI when things were kind of hurting there and during some bad times in our economy. Our founder and CEO came up with the idea to create our own internet company. So we actually have an internet subway is the name of the company. It's its own entity that we own, and we provide all internet for all entire of our 9,200 units across our portfolio. And it's actually we create and actually provide the infrastructure, and it's a line item inside our rent base, inside their lease contracts. It starts at $80 a month, goes up to $180 a month. And we keep the majority of that, say 50 to $60 of that on a monthly basis. Since inception, Internet Subway has created $50 million of NOI for our platform and for our investors, and it creates about 5 million of NOI on an annual basis today. Um, Talk about we are the largest HUD borrower in the country. Our debt structure is something else that sets us apart from other sponsors out there. Today, across our REIT, we have an average date of maturity of 17 year to maturity, an average interest rate of about 3.83% across the board. Back in early when COVID happened, 2020, 2021, when interest rates went down very, very low, near per zero. And a lot of shovels were going to the ground in the marketplace like Charlotte, Nashville, Austin. We hunkered down. We hunkered down in the state of Virginia, and we started locking in long-term debt, 20-year fixed debt, 30-year fixed debt, 40-year fixed debt. And that strategy has really paid off for us today. Our NAV growth and of our REIT started in September of 2021, started at $10 a unit. Today it's at $18.23 a unit. And the first 3 years of that NAV growth was an average rate of return of about 30% because of some structures we come in and help people solve problems for, so UPREIT structures, and then also coupled with our debt strategy and our internet companies really helped solidify that growth. But everyone was kind of taking a little bit of a bath, a lot of bit of a bath in the multifamily marketplace in those days. We were thriving because of our strategy and our debt structure and our also internet company. We focus on multifamily in the Mid-Atlantic and the Southeast region of the country, and we're growing. Today, like I said, we have about a $3 billion balance sheet, 9,200 doors that we can complete across. I'll show you the states we're across, but and we're growing, building out in the Southeast and also looking up north as well. Where we're at in the multifamily um, growth and stage ours today. A lot of people think that the multifamily sector kind of bottoming out or bottomed out. We believe it bottomed out over about 12 months ago. Okay, so a lot of these people that put shovels in the dirt at 5 year variable rate notes, they need liquidity. You know, they need out. Instead of going to the marketplace, they're going to sponsors like us and asking us kind of keep things off market transaction to help kind of solve their problems out there. So there's a lot of blood, there's some blood in the water, and we're out there in the marketplace trying to take advantage of it. Okay. This is just some stats talking about the supply. Supply chain is getting eaten into. There's just not enough supply to keep up with demand in the marketplace for multifamily, especially in the Mid-Atlantic and the Southeast. The housing, it's somewhat of a housing crisis, right? We have a housing shortage, and also the cost of owning a home today is a lot more than it was in the past. So that people are staying in apartments a lot longer. People are getting married a lot later in life. And the baby boomers are retiring on a daily basis, which has also helped drive demand to help with rent growth. Where we invest, again, Mid-Atlantic and Southeast regions, what we talked about earlier before. We're going to continue growing on as far as our strategy with our multifamily, what we buy, what we own and operate, and what we build. Core plus, we do some value add as well in our strategies to help with that NAV growth, not just for sorry, just not for income, but also for some NAV growth for the value add. And here's some of our current assets and some of our current marketplaces we're currently in.
Thanks,
So I'm going to pass
Kerry.
it over to Mike to talk about our tax equity strategy.
Yeah, thanks, Kerry. I'm Mike Auerbach. I'm head of our tax equity solutions. I think most of you deal with clients that, traditionally have real estate as part of their portfolio. I'm looking at this in the lens of how traditional exits kind of, fail. Number one, a lot of investors can sell, take a big tax hit. Anytime that they do that, there's a 30 to 40%, capital gains hit composed of federal tax, state income tax, anywhere from 0 to 13.3% in California. There's depreciation recapture, which is 25% of what someone's already depreciated. And then the Obamacare tax or the net investment income tax, which is 3.8%. So all in all, that's 30 to 40%, depending on your bracket. A lot of folks will utilize the 1031 exchange, which is great. 1031 exchange is when you swap one investment property for another type of investment property without paying a dime in tax. The problem with that is a lot of people are now aging out. They don't want to manage, a single building or multiple buildings that are responsible for their tenants. There's, expense pressure with the insurance going on, and also geopolitical risk with rent control in certain markets. And then, part of our platform, is DSTs, which are great. DSTs allow fractional ownership in institutional type properties where the sponsor manages. An investor can get beneficial interest based on the equity that they put into the deal, and they'll own, a fraction of a large institutional type property that will get them, stable returns. Next. So go back. So this is kind of what I talked about. We kind of have a blueprint here of like, what is kind of our platform and our solution and what's it kind of going towards. So obviously the foundation for your clients is for them to do a 1031 exchange. Like that's the most important part. There's more than 16 different types of pieces of real estate that qualify for a replacement property, and it can be any type of investment property. So someone could sell a piece of land, an office, an investment, an office building, an industrial building, and then they can buy, a multifamily property, a DST, oil and mineral rights. There's a lot of different options out there. The number one thing that they should do is, not pay the Uncle Sam, that tax. Number two, I would say like you would have them go into a DST if they want to become more passive. This is for someone that really wants to take, not have not be responsible for the property management of their property anymore. Still get access to institutional type real estate like a large Class A multifamily property. We have anywhere from one to two of those in the marketplace at each time. A sponsor like Bonaventure manages it, and this is really a strategy. Like the Delaware Statutory Trust is a tax structure in which it yields anywhere from 4 to 6%, annual returns. But the main purpose of it is to, defer tax, not to get an 8, 10, plus percent deal. And then finally, at Bonaventure, we give our investors, the option once the property gets contributed to the REIT to go into a private fund like Beam It, and that's really meant for an investor that wants to transition into more of a wealth management type of system. And so that's kind of what we're operating here at Bonaventure, on our platform. I mentioned DSTs help. They're pretty common, Delaware Statutory Trust, but they're really not the end game. Most sponsors have anywhere from 5 to 10 year holds. But then clients will, wonder, what am I going to do once that goes full cycle? And so some of the positive traits that I mentioned is passive ownership, diversification, and institutional access. Most people can't afford, a 50 to $100 million building with them and their friends. So this is a great fractional way to get into a property like that that's stable. Pre-structured financing and 1031 eligibility. Most of these deals are anywhere from 0% LTV to 50% LTV and solve the debt replacement need. And then, it's really great for reliable income and estate planning. Most of these products are, give monthly or quarterly distributions. Same benefits in real estate with a step up in basis. They can transfer it to their heirs if anything happens. And, all great benefits, for doing a 1031 applied to a DST. So keep going. I think what's gotten popular in the last couple of years is something called a 721, an UPREIT. Just so the audience can understand what that is basically a 721 exchange is when an investor, a landlord will trade their property for ownership, operating partnership units in a private fund like BMIT and participate in a diversified portfolio. So these have been around for, since the late 1980s. Simon Property Group and Avalon Bay and some other firms have used this to really, compound and expand their portfolio. And it's really great for these type of owners to essentially pass their property to great sponsors where maybe there's a, family dispute or they don't want to sell it on the open market and they still want to be invested in real estate and provide a great solution. So think of it like trading one building for a diversified apartment portfolio. Next. Why the 721 is popular? I think you should think of a 721 like an index fund. There's multiple properties in the fund, in many different geographic locations. For multifamily, that can mean thousands of units in, 10 or 20 different cities. Diversified income, no management, a professional sponsor manages it on an investor's behalf. It's succession friendly, estate friendly. If something were to happen to an individual, they'll be able to transfer it to their heirs, and their heirs will go step up in basis. And the next thing is, there's a liquidity, feature to it, which is really interesting. Most people know that real estate is illiquid. With 721s or private funds, depending on the sponsor, there'll be a redemption period. For us, for BMIT, an investor has to be in here for 1 year before they get to liquidate. But it gives the control back to the client, the investor, so they can liquidate their shares on a quarterly redemption basis. You'll hear a lot of terms in the 721 space, like OP units. Those are ownership in the operating partnership. They're kind of like, shares in the stock, if you want to think of it that way. Distributions, many, firms have programs that operate on a monthly or monthly distribution stream with periodic income. And then liquidity, one of the best things is the redemptions or the conversions may be available per program terms. Ours is 1 year, but really, I think the thing that to highlight is it really gives people the flexibility and optionality. What you really need to do your due diligence on is the sponsor to make sure that their private fund is performing well. That's the most important part. Next. So how does one get into BMIT or a sponsor's private REIT? Well, most people don't own 100+ unit property where a sponsor is going to directly upreat and contribute that property like I mentioned before. So there's a couple different ways. Number one, the most common way for investors for anywhere from 500 to $2 million, when they do a 1031 exchange, is to go into a DST. The DST is going to be held by the sponsor for at least 2 years, and it's up to the sponsor to contribute that property when the property is performing well. There's no guarantee that the sponsor is going to contribute that property, but at that time, most programs at most sponsors will have the option to have their beneficial interests translate into operating partnership units in that REIT. So that's the common way. I mentioned, the direct 721 is if there's clients with 100 plus units on the East Coast, our investments team looks at our buy box criteria and they can go in directly. And then finally, we lowered our minimum to 25,000, but let's say someone sells a business or wants other exposure into real estate, you can buy this with cash. So typically what we like to do is as an advisor, you know Kerry and his team will set up kind of a fit check and plan, go over the quick numbers and kind of the goals. um, you know that person will sell and set up a 1031 with a QI. They'll close and go into one of our DSTs in the product on the marketplace right now. And then, if eligible, not guaranteed, will be contributed to, Beam it via 721. So that's kind of the process. The bond venture co-investment case study, part of our platform that is really interesting, I would say, versus other sponsors is we, focus on custom solutions. A lot of people out there, when they get into the 5 million plus range, aren't able to find a DST that suits their criteria. Maybe they want a little bit more control, maybe they want a little bit more flexibility, maybe they want a little bit better return. Here's an example of a property that a client came to us with $9 million of 1031 proceeds that they needed to reinvest. We provided a solution with and sourced a multifamily asset for them with aligned income goals. We completed the equity stack with a JV 5 million co-investment from us. And we structured this with a future 721 pathway into Beam It. And as Kerry mentioned before, we're a HUD large borrower. We secure this with HUD financing. So the structure really is, if someone comes to you and says, "Hey, I've got a $5 million exchange, plus what are my options? I want liquidity. I want to find a new deal." Our investments team does a great job in sourcing that. So, this is another case study. This is an $8 million, client that came to us. Locations in Northwell, Virginia, 156 unit building built in 2017. They had a lot of debt on their property replacement. So, we placed 8 million of equity. Their existing debt's 23 million, and they basically we were able to find a solution for them. So the point being is, whether it's different goals that investors or your clients have, we've done this ourselves before we brought this to market. And, we're trying to help people solve problems so you can, look good for your clients and provide a solution, or at least we can give you, if it's not us, we can hand you to the right people to do that for. So, let's talk about some of the benefits for contributors and shareholders. Obviously, for us in Beam It, we're the largest investor, as Kerry alluded to. We have a fiduciary responsibility to not only ourselves, but our shareholders to make sure that we get good deals. For owners who want to directly contribute their properties, the 100 plus unit, they get tax deferral, passive income, estate planning. It's instantaneous. For the shareholders, they get access to off-market transactions, tax-sensitive capital, scale and diversification, and again, the alignment that we have with we're really true partners when it comes to being in BMIT. Next. We mentioned this earlier, but there are three paths to tax-efficient ownership on our platform. Number one is, again, the 721 exchange is when someone can contribute an eligible real estate property directly. Most people don't have that, so they do a 1031 into one of our DSTs on the market. We'll have anywhere from 1 to 2 on the market at a time. It's ideal for investors, wanting to go into, a long-term plan like Beam It after they do, a DST investment. And then finally, with cash, you can do as minimum as 25,000, to get into Beam It for diversification purposes. Next. Kerry, I'll let you take over this part.
Yeah, well, for the sake of time, we want to keep this around 30 minutes for everyone's time. The key takeaways, as far as our structures and driving our after-tax wealth. right? No one wants to pay Uncle Sam that 30 to 40%, right? DSTs are a bridge, not a destination, right? And this is why we have our REIT, which we have the optionality to 721 up into the REIT after a 5-year time frame. And this is actually just like Mike talked about, gives the great optionality for the investors. It gives a long-term longevity for the investors to get out of their situation. And also, if they do pass on, they can pass it on to their heirs and get a step up in basis and really help out with that tax problem or solution, and give people the liquidity, because our REIT does have quarterly liquidity after 12 months. Um, we will to wrap it up. My name's Kerry Peoples. I'm the head of capital markets here at Bonaventure. This is my team. Please feel free to reach out to us with any questions you guys might have or anything we could assist with. I am talking to RIAs on a daily basis about 1031 exchanges as well, obviously in the broker-dealer world as well. But the RIA space is really, really catching on and growing, more and more interested in getting more cases for these tax equity solutions. And we're here to help. We're here to assist. We're here to partner with you and help you along the way in this path. So we really appreciate you guys' time. We're going to open it up right now for some Q&A and see if we have any questions out there. Mhm. All right, we have a question coming in here. We have one. Here's the first question. For an advisor who only used traditional 1031 exchanges, what usually makes a 721 structure worth considering? Mike, you want to touch base
Yeah,
on
I
that?
think, look, I think a lot of clients, you have a lot of different goals. I think one of them is when they transition to, a certain phase in life, like they want liquidity. Real estate is pretty illiquid. We've all seen what's happened the last 6 years with COVID and the boom, and now with interest rates. And I think it's a great estate planning tool. And it's great for RIAs like to be able to, custody it and, be able to bill it as AUM. Kerry, you can kind of, expand on that a little bit, but mainly I would say the diversification piece, like the index fund, Beam It, for example, has 24 properties, 4,400 units all throughout different cities. It's really great against single asset risk for one deal where we know if there's a fire or if the geopolitical risk changes or climate or insurance goes, there goes their return. So it's really about preserving income.
Yeah, agreed, Mike. Thanks for that. Another question, great question. Where do advisors and clients make the most mistakes during the 4 to 5 day identification period and 180-day exchange timeline?
Yeah, I think like it all comes down to planning. So if you have a client that is thinking about listing their property, like you want to get ahead of it before they're under contract and close on their property, and then there's a 45-day clock. The most sophisticated family offices that we work with and successful investors when they do 1031s, they start it right away when they want to know like when they figure out like I want to trade my property and not pay taxes, like it, you know, talking with Carrie or talking with myself or getting the right people to help formulate a plan is definitely the right way to go. You never want to have the tax tail wag the dog, meaning you don't want to make a bad decision. It's probably best to opt out and pay the tax, but to be successful, you got to plan ahead and no one wants to, be put in a situation where there's a deadline with a lot of money at risk. So I would always say plan ahead.
Right. Yeah, I would agree with that as well. All right, last question here. If a client is not ready to act today, what are the signs that now is still the right time to start planning for a future 1031 DST or 721 strategy? And I would say it's never too late. I think you always start talking about it. And I always tell my partners and friends out there in the marketplace that if you're not talking to your investors and your clients about their real estate holdings and about a 1031 exchange or a possible 1031 exchange and educating them now before anything, someone else is. So I would always advise and say always get out in front of head and your clients and talk to them about their real estate holdings and start unfolding that more and more of that wrapper. So there's never too late. I'd start talking to them today and continue and start those conversations. And we're here to help. So we're here for guidance, assistance, and any questions you guys have along the way. Again, just like Mike said, if we can't help you, we'll find someone else who can in the marketplace. We have a lot of friends in the marketplace that do similar things and different strategies around the country, and we're always here to help out and make introductions as well. Mike, you want to close with anything?
No, I just want to thank everyone for being here. Like Carrie said, we're here to help. I think, sometimes when you don't know the right answer to someone's question, like that's where you can utilize us. And, communication amongst clients and information is the most important thing to provide value today. So we want to thank you guys and hope everyone has a nice weekend and, hope to speak with you guys, in the future.
Yeah, thanks everyone for joining. We will talk to everyone soon. Thanks again.